Okay, so I'm going to pick up roughly where we left off last Wednesday. This unit's going to deal with returns to stocks, really returns to any asset this would apply to, but we're going to sort of think of it as returns to stocks. And eventually we're going to do some statistics on that and think about portfolios of stocks and how the returns on a particular portfolio, how to determine those based on the returns of the individual stocks, as well as the variance of a portfolio, and how that depends on the variance of the individual stocks, as well as the covariance between the stocks. We'll get to that later on in this lesson. The fundamental unit of analysis, though, is the return on the stock. And so the stock returns, if you're the owner of a stock, that entitles you to a couple of different things. You get to earn some dividend income. So if you own the stock over the course of the year, you can earn a dividend over that year. That's extra cash that the firm has, which they decide to pay out to shareholders. And you can also earn a capital gain if the price of your stock goes up over the time that you're holding it. You could also have a capital loss in the event that the stock decreases in price while you're holding it. But that's going to be the basic composition of the return. It's going to be some combination of dividend income and a capital gain. And we went through some of these examples last time. We talked about how you can express the returns in dollar levels. That's what's being done here on this slide. And then you could also convert that to percentage returns. That would be an expression of a yield. And really what you just do to obtain that is you divide the dollar return or the dollar income divided by what the price of that stock was at the beginning of the year. So that exercise can be shown here. You can see that the dividend was $1.85, so the dividend yield is $1.85 divided by 37. That's shown right here. The capital gain, the price that you bought the stock for was $37 per share. After 1 year, the stock price had gone up to $40.33 per share. And so you gained $3.33. And if you think about that relative to the $37 that you invested initially, that's about a 9% return. So then your total return is the dividend yield, which was 5%, plus the capital gain yield, which is 9%, for a total return of 14%. So we just looked at a case of the returns over a single year. We can think about this more generally for n years. And in that case, you're going to multiply the percentage returns year upon year. In the case of a 4-year, let's say you wanted to calculate the 4-year holding period return, you'd figure out what the return is in the first year. That would be R1. You'd do 1 plus the percentage return in year 1 times 1 plus percentage return in R2. And then you take that and multiply that by 1 plus the percentage return in the third year, up through year 4, and then you subtract 1 at the end to put it just in a percentage basis. We can think about this just as a simple example with a stock that is fluctuating in price and paying out some dividends. So the price is going up and down over time, over the holding period, over the 5 years that you're holding the stock. And then it's also paying out a dividend. So the ownership of that stock entitles you to these amounts of dividends that are paid out on this yearly basis. And then we can actually go through and just make the calculations for each year. We have some dividend yield, some capital gain yield. We can figure out what that total yield is for each year. That's what's calculated in these numbers here. All of these percentage numbers are the total yield on the stock, including the capital gain yield and the dividend yield. And if we know the individual yearly returns, we can combine them according to the formula that we were just looking at right here. You can combine them according to that formula and calculate the 5-year holding period return. If we were to buy this stock in year 0 at $28.08 per share, and we were to earn dividends over the course of years 1 through 4, and have the stock price fluctuate, after that time, that would be equivalent to a holding period return that is, you'd earn 2.74% on your initial investment. Now, we've been thinking about this in these examples in terms of stocks, but this applies to any asset. More generally, it can apply to any sort of asset, including bonds. And if you just consider instead of a dividend payment, if you think about the coupon payment of the bond and you think about the price of the bond, you can do the exact same calculation with a bond. So if we have a $1,000 bond that has a 4.4% coupon rate, which pays out coupons annually, let's say the bond is trading at a price of $963.11. That's what you buy the bond for right now. And then in 1 year, you get the coupon, which is the 4.4%, which is 4.4% of the $1,000 face value of the bond. So that's a flow of income that you get from owning the bond. And then you also would capture any change in the bond price after you sell the bond. If you are able to sell the bond at a higher price than you paid for it, in this example, we are able to sell it for more. We're able to sell it for $989.27, whereas we paid $963.11 for the bond. And so we would have also some capital gain as well as some income from the bond. Income would just be the coupon that we would get. And so the holding period return for that bond, buying it at $963, selling it at $989, and getting the $44 coupon payment over the course of the year, that would result in a 7.28% holding period return for the bond. If the bond were still, let's say the bond didn't change in price at all, if it were still $963.11, then the holding period return would just be the $44 coupon divided by the price of the bond that we paid for it, and that would result in a 4.57% holding period return. So that's the basics of returns. These are going to be what we use. This is what we do statistics on in order to analyze expected returns as well as think about the variance of different assets. Now, there are actually two different ways of calculating so-called average returns on a stock. One is to take the arithmetic mean, which is just simply, that's the sort of the colloquial way of, the colloquial sense of the word average, where you just take the individual annual returns and you divide them by the number of years that you're considering. That would be this R bar that I have in the middle. Another way to do it would be actually to think about the geometric return or the geometric mean return, and that would be what you would have to earn each year to obtain the observed holding period return. And the exact formula for that is if it's a 3-year holding period, you'd have 1 plus the returns in year 1 times 1 plus the returns in year 2 times 1 plus the returns in year 3, and you take the cube root of that, and then you subtract 1, and that would give you the geometric mean, which sort of tells you how much, that tells you what your annual returns are that would result in the holding period return that you observe. So these are two measures of averages. We're basically just going to be dealing with the arithmetic mean, but there's also the geometric mean is also a commonly computed statistic. So the formal definition of variance is you take the returns, in year 1, that would be R1, sound like an arrow, and you subtract off the mean returns over the period that you're interested in. and then you square that. So it's the deviations from the mean squared. You square the deviations from the mean, and you add those up for each individual year. So this would be the squared deviation in year 1. This would be the squared deviation in year 2. All the way up to year t, you do that for each year. And then you divide that. In this case, if you're looking at the sample variance, you don't divide that by t, you divide that by t minus 1. That's something that comes out of the statistics. You actually lose a degree of freedom because you use 1 degree of freedom to calculate the mean, R bar, and so you're not able to divide. It would not be an unbiased estimate if you divided by t. You have to lose 1 degree of freedom and divide by t minus 1, which has a small effect of making the variance a little bit larger because you're using the actual observed data to compute the R bar to begin with. But this is the formula that you would use for computing variance. That is the sample variance. I should just be clear, that's the sample variance. And then if you take that sample variance and you take the square root of it, then you get the standard deviation. And typically, standard deviation is what will measure the risk in terms of standard deviation rather than variance. This idea actually came up a little bit when we were talking about real options, but we typically think about risk as being a bad thing. But there's also upside to holding something that's risky. And if you have something that's risky and you say have an option to exercise or purchase or take some action which lets you capture the upside without getting the downside, then that's actually can be a very positive thing. And as I mentioned just a second ago, the standard deviation is in the same units as the returns, so that's why it's more convenient to express risk in terms of the standard deviation of returns, because it's in percentage terms rather than percentage squared terms. If you're doing these calculations in Excel, you want to use for standard deviation, you want to use stdev.s to calculate the sample standard deviation. If you're looking for the sample variance, that would be there.s as well. Now, if you just use the standard deviation without .s, then that will give you the population standard deviation, which actually would technically be a biased estimate. And so if you have data that you're using to estimate the variances, then use the function .s rather than just the straight up function. If you actually know what the probabilities are for different outcomes, if you know the exact probabilities of different returns, if you know those for a fact, then you wouldn't actually have to use the correction t-1. You could just multiply each of the returns by the corresponding probabilities, and we'll get to an example of that in a second. But if you are estimating the returns using the data that you have, then you lose the degree of freedom and you have to divide by t-1 rather than t, and that's what this variance.s function will do. It'll automatically account for the loss in the degree of freedom. So all of this build up on returns, studying how to calculate returns and take statistics, this is all building up toward being able to analyze portfolios of stocks. In this graph, we have data on the y-axis that indicates historical returns. So that's the return, that's going to be the capital gain yield plus the dividend yield on a particular asset, and that's in percentage terms on the y-axis. On the x-axis, we have the volatility of the asset, and that's measured in terms of standard deviation. That's a measure of central tendency. That's how much the returns tend to be bunched up around the mean. Do they tend to be spread out? If they do tend to be spread out, the standard deviation will be large. If they tend to be very tight around the mean, then the standard deviation will be very small. But this cloud of dots on the kind of the right-hand side of this graph, those are individual stocks. And then the red squares are actually portfolios of stocks. These are portfolios of small stocks. If we're talking about this red dot here, or this red square up in the top right, if we're talking about portfolios of mid-sized company stocks, those would have average returns of around 15% and a volatility of about 27%. Then over here we have larger portfolios such as the S&P 500 as a whole, as well as a portfolio of all world assets. Even further on the left, we have corporate bonds and treasury bills. Now, one of the characteristic features of this graph is that there's kind of an inverse relationship between average return and the volatility, which tells you something about how investors are going to require higher returns when the underlying asset is more volatile. For very safe assets like treasury bills or corporate bonds, the required return that investors are going to expect is not going to be as much as what they will expect if the returns are very risky. This is just a demonstration of the classic risk-return trade-off, where if you're going to be asked to hold something that's risky, you're going to require something in return, which is a higher average return. Now, it's important to note that this relationship doesn't actually hold very well for individual stocks. So we see this cloud of individual stocks, which doesn't really have the same linear pattern. It's just sort of a big cloud. There's not really any systematic relationship between return for an individual stock and the volatility of that individual stock. However, that relationship does hold for the larger portfolios, as portfolios of small stocks, mid-sized company stocks, or the S&P 500 as a whole. And in that case, you do see a sort of a direct relationship between the volatility of the portfolio and the average returns that you see on the portfolio. So there's actually one thing I want to point out here, and that's the fact that you have all these stocks clumped over here on the kind of the right-hand side of the chart. And these are all the individual stocks in the S&P 500. But the S&P 500, a portfolio of the S&P 500 as a whole, is sitting over here. And it's to the left, it's all the way to the left of all the individual stocks. So we see that it has about the average return of all the individual stocks. It's about in the center of this cloud. If you're thinking about, if we draw a horizontal line, it's about right down the middle of that cloud. But it's all the way over to the left of all the individual stocks. And the reason for that is that it's a diversified portfolio. So it has a lower volatility or a lower standard deviation than all the individual stocks. And you might think, how can that be? Because it's just a composition of all the individual stocks. But there's actually this thing called the diversification effect, where as long as the individual stocks are not perfectly correlated, you can reduce the variance of a portfolio by having it be a mixture of two or more individual stocks. As long as the stocks are not perfectly correlated with one another, a portfolio that includes some of each is going to have a lower variance than the sum of the individual variances. We'll get to that a little bit later, and I actually have a mathematical derivation of that I can post on Canvas just to show that that's true for any portfolio of two assets. Now, this idea of diversification, this only takes care of one kind of risk. There's sort of broadly speaking, two kinds of risks. One is unsystematic risk or independent risks. These are very specific to individual events or individual companies. This is the kind of risk, this systematic risk, is the kind of risk that you can actually diversify away. By holding a bunch of different assets for a lot of different companies, you can reduce the variance, reduce the risk, because you don't expect all of them to all go south all at the same time. There's going to be fluctuations that are going to happen somewhat independently. And by diversifying, you can get rid of that kind of unsystematic risk. Now, even after you diversify, you're not going to be able to get rid of all kinds of risk, such as systematic risk. And this is the risk that's just inherent in life, that's just inherent in the economy. You will never be able to eliminate risk completely, but you can eliminate the unsystematic kind of risk by diversifying your portfolio. When you combine a bunch of different stocks in a large portfolio, the unsystematic risks are going to tend to average out. And this is what the diversification effect is giving you. It's sort of allowing you to cancel out a lot of the noise, the day-to-day fluctuations, the random events that happen to individual companies. Those sort of wash out if you hold enough different companies. They're not all going to be having terrible years all at the same time. Some of them are going to be up, some of them are going to be down. Those sort of average out. And that's the benefit you can get from diversification. Now let's go through just a little exercise on calculating expected return and variance. So we have this company, this hypothetical company, SuperTech, and it's going to have returns that are based on the state of the economy. There's 4 different possible states of the economy. There's a depression, a recession, a normal economy, and a boom. Each of those have the probabilities that I've listed here in parentheses next to each of those contingencies. And the returns that are associated with each of those states of the economy are listed in the table on the right. Now, if we remember some results from probability theory, we can remember that the mean of a random variable is equal to the sum over all the different contingencies of the probability of that event happening times the value of that contingency. In this case, we're thinking about returns. So our returns are going to be given by Ri, that is the returns in contingency I, that is each I represents the different states of the economy, depression, recession, normal, or boom. And then Pi represents the probability. So this would be how you would calculate the average returns. And we could call this R bar for the mean returns. Now, if we're also thinking about variance, that has an equivalent or a corresponding formula as well. The variance, that's going to be given by the sum over all contingencies of the probability of that contingency times the value of returns in that contingency minus the mean, and you're going to square that. That's going to be that's technically the formula for variance when you know the probabilities. And let me just stress, this is for the case where you know what the probabilities are. We're just going to assume that we know that these states of the economy are going to occur with these probabilities. So these probabilities are given, and this is how you calculate the variance. If instead of knowing these probabilities, we were just trying to estimate these, then you'd have to use the sample variance formula, which was on the previous slides. So if we apply these formulas, these are the results that you'd get if you're just doing exactly the math that I had just wrote down on the previous slide. You'd calculate the mean, you'd find the mean return is 19%. The variance according to that formula that I had up above, that's going to be 329%. If you take the square root of that, that's 18.14%. So this would be the result of calculating the mean and the standard deviation of returns in the scenario with that hypothetical company. Now, we just measured that for individual stocks, but this idea of diversification hinges on this idea of covariance, or the co-movement between different assets. And the measure we use to quantify that is this idea of covariance. This formula has a similar structure to variance, where variance was the returns in year I minus the mean returns squared. Instead of squaring it, though, you multiply by the returns of the other stock. In this case, we have stocks A and B. Returns of stock B minus the mean of B. You multiply those together. You add them up over all the years that you're interested in, and you divide that by T minus 1. Again, the T minus 1 comes from the fact that it's the sample statistic rather than knowing the exact probabilities of all the contingencies. And then from the covariance, we can compute what's called the correlation, which is just given by this formula here. It's where it's the covariance on top, and then divided by the product of the individual standard deviations. This is going to be scaled to be between -1 and 1. So if this value is 1, that means there's perfect correlation. Those variables move exactly the same, in the same direction at the same time. If it's -1, that means there's perfect negative correlation. That means they move in the exact opposite way from one another. And if it's 0, that means they have no covariance at all. They don't have any systematic pattern of co-movement. So we can apply this process to data. In this case, it's returns from stock X and Y from 2004 to 2009, different returns for each of those stocks. If we apply just the procedures that we've just been discussing, we can take each of those individual returns. We can compute the mean. In this case, this isn't shown, but the mean for stock X is 24.77 roughly percent. The mean for stock Y is roughly 3.48%. So in the columns for the deviations, in this column for X and Y, these deviations are the individual yearly returns minus the mean. And those values are computed for both stock X and Y, and then those are multiplied together to get the product, and then that product is summed up just how it says to do right here. And so if you just apply that formula, that will give you the result that we have here for the covariance. Then the correlation can be found by just taking that covariance and dividing it by the product of the individual standard deviations. And when you work that out, you'll get 0.6927. You can do that on your own. So those were some sample statistics for those two stocks. Now we're going to think about what happens when we put two stocks together in a portfolio. The expected return isn't all that tricky. It's just the weighted average of the individual returns. So if we have a portfolio where XA is the proportion of the portfolio held in asset A, and XB is the proportion of the portfolio held in asset B, then the expected portfolio return is just given by this equation here, which is just, again, a simple average of the individual returns. Now the formula for the variance of a portfolio is a little bit more complicated because the variance is a higher moment than the mean. It's the second moment of a sample statistic, and so there's more complicated formula for the variance of a portfolio, which is given here. In this case, we take the proportion of the portfolio that's in asset A and we square it. That's what this x sub A squared is. We multiply that by the variance of A. We do the same thing for B. And then we have this term out here, which is 2 times the proportion of the portfolio in A times the proportion of the portfolio in B times the covariance between A and B. And this term on the right is actually where most of the action is when we're talking about diversification. And we'll get to this in a second, but this covariance between A and B is going to be critical for determining whether there is a diversification effect and how big that effect is going to be. So let's use an example to demonstrate the diversification effect. Let's say we're going to invest $60 in firm A, $40 in firm B. So we're having a $100 portfolio that we're splitting up between A and B. We have some expected return for A. We have some expected return for B. Those are given here. We have some individual standard deviations for A and B. Those are given in the rows 3 and 4. We have the covariance between A and B. And then we have the correlation, and that can be computed just as we had done on the previous. Now, if we use the formula that's on the previous slide, this variance of a portfolio, and if we apply that to this example here, we apply that formula here, and we find that the variance of the portfolio is 0.023851. If we take the square root of that to get the standard deviation, we find that the standard deviation of a portfolio that's 60% A, 40% B, standard deviation of that portfolio is 15.44%, which is greater than 15.44%. This is precisely what we mean when we say there's a diversification effect. The weighted average of the standard deviation of the individual stocks is larger than the standard deviation of the portfolio of stocks. And the source of that difference is the co-movement of the 2 stocks. The fact that they don't move perfectly together, that sometimes one is up and the other is down, and then when one is down, the other is up. That's what is implied here by this correlation of less than 1. And this is the thing that's driving the standard deviation of the portfolio being less than the weighted average of the standard deviation of the individual stocks. Now, we don't actually need this correlation to be negative. It is negative in this case, which actually especially helps in diversification. But it doesn't need to be negative. It actually only needs to be less than 1. As long as there's not perfect correlation between the 2 assets or the 2 stocks, then there will be a diversification effect. There will be some benefit, a way to reduce overall variance by combining the 2 together in a portfolio rather than having them separate. Now, if we remember this fundamental relationship from before, I'm just putting it up here above the slide, where the correlation is equal to the covariance divided by the product of the individual standard deviations. If we remember that, then we can actually rearrange this to express the covariance as the product of the correlation times the individual standard deviations. And as long as the correlation is less than 1, that's going to allow this term, this formula for the variance of the portfolio, that's going to imply that this is less than the standard deviation of A times XA plus standard deviation of B times XB. As long as this row, this correlation is less than 1, that will ensure that this inequality holds. Now, back in our discussion of the difference between unsystematic and systematic risk, we mentioned that unsystematic risk can be diversified away but there's always going to be some level of systematic risks that still persists that we're not going to be able to get rid of. We can get rid of the unsystematic risk if we increase the number of securities in our portfolio. We can cause that to reduce and go down this curve if we increase the number of securities in our portfolio. But there's a limit to how much that can actually eliminate overall risk, because there's still the systematic risk. That's still the risk of just overall trends in the economy happening, things that are just inherently risky that are not going to help you if you hold a diverse portfolio. Things like natural disasters, hurricanes, outbreaks of disease that affect the whole economy all at once. Those are not going to be things that it's going to help to diversify with, and you can't eliminate your risk and exposure to those, but you can eliminate your exposure to idiosyncratic or unsystematic risk, which is the risk that occurs on a small scale, company by company. So now that we have some tools, some statistical tools to evaluate different characteristics of portfolios, the question now is, how do we design and build a portfolio? There's different ways of doing that. There's different objectives you could have. In one case, you might be wanting to maximize the return on a portfolio. In another case, you might be wanting to minimize the risk of a portfolio. Those are not going to always be possible to do together. You might have to trade those off against one another in some sense. And we can illustrate this trade-off with a simple example with two different stocks. Let's just take the case of ExxonMobil stock and Solar City stock. The expected return on ExxonMobil, let's say, is 7%. The standard deviation on ExxonMobil is 5%. Let's say the expected return on Solar City is 22. The standard deviation on Solar City is 10. Let's say they have a covariance of 0.0001. Now, if we can only hold a portfolio that consists of these two stocks, how much of each one would we want in the portfolio? That's sort of the question that we'll be thinking of next. There's going to be this trade-off between risk and return, where the more we have in maybe the high return stock, the riskier our portfolio is going to be. The more we have in maybe the low return stock, the lower risk our portfolio is going to be. And we're going to have to be choosing some combination of risk and return by choosing a portfolio that has more of one stock versus the other. And we actually have the tools to calculate exactly what the expected return on a portfolio is for different shares of the portfolio in each of those assets. We saw that the expected return on a portfolio is just the weighted average of the individual returns weighted by the shares in the portfolio. The portfolio standard deviation was a little bit more complicated calculation, but still nothing impossible. I put up the formula for that here above this slide to just remind you what that formula looks like. It's the square of the share of the portfolio in A times the variance of A plus the square of the share of the portfolio in B times the variance of B plus 2 times the individual shares times the covariance. And we can do that, we can apply that to this case of ExxonMobil and Solar City, and we can arrive at the returns to a portfolio and the standard deviations of the portfolio, which are based on different shares in each one. So each of these portfolios 1 through 7 is some combination of these two stocks. In portfolio 1, it's all ExxonMobil, no Solar City. In portfolio 2, it's 90% ExxonMobil, 10% Solar City, and on down the line to portfolio 7, where it's all Solar City. These are going to each of these portfolios results in these expected returns and these expected standard deviations, portfolio standard deviations. And we can plot these out. We can plot, so we can plot out, like, we have return, we have risk, and we have exactly those two parameters in this table here, in this square box I've drawn here. We can actually take those, plot those out in a two-dimensional plot. And that will look as follows, a little bit nicer than I had drawn it on the previous page. These are all the different sets of risk and return that are implied by different shares of ExxonMobil and Solar City in your portfolio. So you range from a portfolio that has a high return and a high volatility. That's if you have all your portfolio in Solar City. Then you have a portfolio that has a low return and low volatility. And then changing the share, actually, you can trace out a frontier that represents the combinations of risk and return that each of those portfolios represents. Now, again, our choice is, we're trying to choose a portfolio. There's different ways we could choose. We could choose something that has low risk. We could try to get the standard deviation of the portfolio as far to the left as we possibly can, moving as far to the left, reducing standard deviation as much as possible. That would be minimizing risk. Or we could think about trying to get the most return for a given level of riskiness in the portfolio, and that's defined by something called the Sharpe ratio. Let me just define the minimum risk formula first. This is the formula for the portfolio, the share that will give you the minimum risk. So this is the amount of your portfolio, the percentage of your portfolio that should be taken up by ExxonMobil. If you're trying to minimize risk, you take the variance of Solar City, subtract the covariance of the two stocks. You divide all of that by the variance of ExxonMobil minus 2 times the covariance of the two plus the variance of Solar City. There's a derivation of that I have written down. It just comes out of the first order conditions from minimizing the variance of that portfolio by choosing the share. You don't have to derive that yourself, but I can show that derivation too if you want to. But if you plug in, these are just the parameters that we were looking at before. These are just the individual variances and the covariance, individual variances and the returns. All that stuff. Oops. All that stuff just comes from right here. When you plug that in, then you can get the optimal portfolio, or sorry, not the optimal portfolio, but the minimum risk portfolio is going to have 80% of it in ExxonMobil, and that's represented by this this point, roughly right here, where you sort of get as far over to the left on that frontier as you possibly can. That's one way to do it, would be to minimize the risk. The other way to do it would be to maximize the Sharpe ratio, which would be essentially getting the most return that you can out of a given level of risk. And this is going to be always relative to the risk-free rate. So we're always going to assume that we have some ability to invest in a risk-free asset that's going to have 0 standard deviation and some positive return. And so the Sharpe ratio is given by the difference between the return on the portfolio, RP, and the risk-free rate of return. You subtract the risk-free rate from the return on the portfolio, and then you divide that by the portfolio standard deviation. That gives you the Sharpe ratio, and that's one metric that tells you how much return you're getting for a given level of risk. And you can see that you'd want to have this as high as possible. It'd be more advantageous to have a high return on the portfolio relative to the risk-free rate divided by the standard deviation. That would obviously be a better portfolio, one that would return more for a given level of risk. So we can compute the Sharpe ratio for our portfolio. We plug in the return on the portfolio, subtract the risk-free rate, we divide it by the standard deviation of the portfolio. Those parameters are going to depend on the shares. So we do that for each of the shares. We plug those into this Sharpe ratio formula, and we can get a set of Sharpe ratios for each of the different portfolios. And we can see that one of these portfolios actually has the maximum Sharpe ratio. In that case, that would be portfolio 5. That has a Sharpe ratio of 1.99, which is higher than any Sharpe ratio for any other portfolio. And that portfolio essentially represents the highest return that you can get for a given level of risk in your portfolio. And we can actually show this graphically by this yellow line, which is the line between the risk-free rate, drawn between the risk-free rate and then somewhere just touching the portfolio frontier. And you can see that it would be advantageous. You'd always want to have your portfolio be as far up into the northwest as possible. You'd love to move further northwest if you could, up in here, up in this northwest zone. This is high return, low risk. So the idea is to move as far northwest as you can, given the feasible portfolios that you have. Remember, the blue line represents the feasible portfolios. Those are the portfolios that are attainable based on the two assets that you have to invest in. And then this Sharpe ratio represents sort of the maximum difference between portfolio return and the risk-free rate relative to the risk that you're taking on. And so wherever this yellow line is just tangent to the portfolio frontier, wherever the yellow line is just tangent to the blue portfolio frontier, that's the highest risk that you can get relative to the standard deviation. Sorry, that's the highest return you can get relative to the standard deviation of the portfolio. Now, if we wanted to, we could create some portfolio that was some combination of the risk-free rate and a point on our portfolio frontier. We could have a combination of the risk-free rate and 100% ExxonMobil stock. In that case, we could attain any point along this. We could attain any point along this black line if we combined just ExxonMobil stock with the risk-free rate. But when we can combine the risk-free rate with ExxonMobil with Solar City, we can actually push that line up further toward the northeast and get a higher return for a given level of risk. And that's essentially what's happening when we're maximizing the Sharpe ratio, is we're trying to get as much return as we can for a given standard deviation. And geometrically, that's represented by the point at which the Sharpe ratio is exactly tangent to the portfolio frontier. We can actually see this mathematically if we remember that the Sharpe ratio is the return on the portfolio minus the risk-free rate divided by the standard deviation. That gives us a clue to why we can have this geometric interpretation of this tangent, this yellow tangent line, this line that's tangent to the portfolio frontier. The numerator here is the difference between the return on the portfolio and the return on the risk-free rate. So in some sense, that's this vertical distance between the return on the portfolio and the risk-free rate. That's essentially the change in Y. And then the change in X, that's the standard deviation of the portfolio. That's the denominator. So maximizing the Sharpe ratio is essentially getting as big of a change in Y as you can for a given change in X, and that's why there's the geometric interpretation of the maximum Sharpe ratio as being the tangency between the line originating from the risk-free rate and the portfolio frontier. So the important points from lesson 6, the idea of returns, the fact that you want to have a way to calculate the returns on a stock, which is going to include the dividend income as well as the capital gain. Those returns, those are what produce overall returns on stocks or overall returns on assets. And we can do statistics on those returns. We can calculate the means and variances to figure out what's the average return we're getting on a particular asset, what's the volatility of a particular asset. And then we can do analysis of portfolios by looking at covariances between assets and figuring out what the standard deviations of particular portfolios are going to be. And then we can start doing some optimization of portfolios, and either, depending on what our objectives are, this will allow us to either minimize the risk of a portfolio or maximize the return relative to the amount of risk, which is what it means to maximize the Sharpe ratio. And that's what it means to have this this yellow line be as far tilted up to the northwest as humanly possible. So this will be the main things that will be covered on exam 2. It'll be the basic statistics, being able to calculate returns on a stock, returns on a bond, figuring out the yields, capital gain yields, dividend yields, doing calculations for the means of portfolios or expected returns of portfolios, and then being able to calculate the standard deviations of portfolios, and then using those metrics to determine an optimal portfolio given some objective.